Welcome to this deep dive into how car financing and leasing actually work in Canada and the United States. This video will walk you through the mechanics, the differences, the hidden traps, how dealerships profit, and how to protect yourself from the most common industry tactic. In North America, you generally have three ways to get a car: pay cash, finance it, or lease it. Financing means taking a loan to own the vehicle. Leasing means paying for the depreciation and returning it at the end, unless you buy it out. Financing a car is essentially a loan. You borrow the purchase price minus your down payment, pay interest, and own the vehicle once the loan is complete. Terms typically range from 36 to 84 months. Financing builds ownership, lets you drive unlimited kilometers, and gives you the freedom to modify or sell the vehicle at any time. But financing means higher monthly payments compared to leasing. You also absorb all depreciation, long-term repair costs, and negative equity risk. Leasing is like renting with conditions. You pay for the value the vehicle loses during your contract term, plus interest, plus fees. At the end, you return it, unless you choose to buy it at the predetermined residual value. Leasing usually means lower monthly payments, lower sales tax burden in certain provinces and states, and you always drive a relatively new, warranty-covered vehicle. The downsides: mileage restrictions, strict wear and tear standards, end-of-lease fees, no equity buildup, and higher long-term cost if you keep leasing endlessly. Leases are built on four numbers: the capitalized cost, the residual value, the money factor, and the term. Residual value is crucial. It determines how much depreciation you pay for. Money factor is the interest rate in disguise. Dealerships profit most from financing and leasing, not outright sales. They receive back-end commissions from lenders, mark up interest rates, add unnecessary products, and bury fees in the contract. Many customers never notice. The money factor is often intentionally confusing. Convert it to APR by multiplying by 2,400. If the dealer doesn't want to disclose it, that's a red flag. They may be marking it up. Rolling negative equity into a new loan is one of the industry's most profitable traps. It keeps customers stuck in perpetual debt while dealers continue selling new vehicles at inflated margins. Many add-ons are overpriced. Rust-proofing, tire insurance, paint protection, VIN etching. These can be bought independently for a fraction of the dealership price. Leasing makes sense for people who deduct vehicle costs through a business, drive predictable mileage, or prefer switching cars every few years. Financing makes sense when you want long-term savings, drive high mileage, or plan to keep your vehicle beyond its loan term to minimize cost per year. A lease buyout can be a huge win when the market value is higher than your residual value. But some lenders now restrict third-party buyouts because they want to profit from the equity instead of you. Dealerships often mark up the interest rate the bank approved you for. They keep the difference as profit. Always ask, what rate did the lender approve me for? And are you marking this up? Manufacturers often subsidize financing and leasing with rebates or artificially low interest rates, but these can't always be combined. Choosing the right incentive can save thousands. To protect yourself, research interest rates, negotiate the selling price even on leases, avoid unnecessary add-ons, compare buyout values, request the full contract before signing, and never roll negative equity. Whether you should finance or lease depends on your driving habits, financial goals, and tolerance for long-term cost versus short-term cash flow. Understanding the mechanics and the hidden traps puts you back in control. If you like this video, please like, comment, share, and follow for more.